Welcome back to The Explainer. So today we are unpacking a really fascinating source that claims to map out exactly how Larry Fink built a financial empire that, quite literally, controls the modern world. We're going to be looking at the playbook behind BlackRock. It's an organization that operates largely behind the scenes, yet it touches almost every single aspect of global finance.
$68 trillion. Just let that sink in for a second. According to our source material, this staggering figure isn't just some random pie-in-the-sky statistic. It is the ultimate endgame mapped out by BlackRock's leadership. Over the course of this explainer, we're going to see exactly how a firm goes from absolute zero to targeting a $68 trillion piece of the global pie.
Part 1. The $100 million mistake. To really grasp the company's massive current scale, our source takes us all the way back to the beginning. The year is 1976, and a young, incredibly ambitious Larry Fink steps onto Wall Street to join the investment bank First Boston.
Our source brilliantly describes the concept of mortgage-backed securities as a kind of financial casserole. You basically take a bunch of individual home loans, bake them into one giant product, and then slice it up to sell to investors. And Fink? He was a pioneer of this exact product. He practically helped invent it in the 1980s, printing millions for his firm by effectively monetizing the American dream of home ownership.
So Fink was rising faster than literally anyone in First Boston's history. But then, he made a massive bet on interest rates rising. He bought financial insurance to hedge his bet. But there was one single, devastating numerical mistake in his calculations. When interest rates actually plunged instead of rising, that one miscalculated hedge cost the firm a cool $100 million. He was fired, he became a Wall Street outcast overnight. But more importantly, it taught him a lesson that would change finance forever. Risk is a highly dangerous drug.
Okay, let's dive into part 2, the risk management machine, and how BlackRock is born. Fink was cast out, sure, but he was far from finished. He vowed to rebuild his career by becoming the absolute master of managing risk. He wasn't just going to take risks anymore, he would analyze them better than anyone else on the planet.
But to get back in the game, Fink needed capital. In 1988, he partnered with legendary financier Stephen Schwarzman of Blackstone. He secured a $5 million lifeline in exchange for a 50% stake in his new venture. Now, this aggressive, risk-focused growth was incredibly successful, but it eventually led to a massive power struggle between the two. By 1994, Fink and Schwarzman split, leaving Fink in absolute, full control of his newly named firm, BlackRock. This brings us to how BlackRock really separated itself from the pack. You see, while traditional investing separated risk oversight from day-to-day investing, BlackRock built a computerized brain called Aladdin. Standing for Asset Liability, Debt, and Derivative Investment Network, Aladdin basically became the Windows of global finance. During the 1994 Great Bond Market Massacre, while everyone else was bleeding money, Aladdin's rapid simulations saved BlackRock. It proved to the entire financial world that when risk gets complicated, you need to call Larry Fink. That reputation became a real game changer as we reach Part 3, Winning the 2008 Crisis. Now, 2008 was a global disaster, caused ironically by the very mortgage-backed securities that Fink had helped invent decades earlier. But our source points out that because Fink understood these assets so deeply, BlackRock was perfectly positioned to capitalize on the chaos.
The source outlines a very specific playbook for how this went down. First, BlackRock used Aladdin to sidestep the worst of the toxic assets. Then, flush with cash, they bought Barclays Global Investors for $13.5 billion. Why? Because it included iShares, the absolute leading provider of passive exchange-traded funds, or ETFs. This single massive move made BlackRock the world's largest asset manager. By owning these giant ETF funds, BlackRock suddenly became a kingmaker, holding immense voting power in everyday companies you know, like Walmart and UPS.
At the exact same time, the government was in a full-blown panic. The source includes a really telling quote regarding Timothy Geithner, a key U.S. central banker at the time. There was a day in which Geithner called him 21 times in a day. The source asserts that the Federal Reserve effectively outsourced its crisis response entirely to BlackRock and its Aladdin system. This basically cemented an unmatched level of political influence for the firm.
Following the 2008 crash, regulators clamped down hard on major banks with the Dodd-Frank reforms, creating this too-big-to-fail label that brought incredibly strict oversight. Yet the source notes that BlackRock completely avoided this. Through aggressive lobbying, including a direct sit-down with President Obama, BlackRock successfully argued that they were merely a passive investor, just managing other people's money, right? Well, this self-determined label allowed them to completely dodge the strict rules applied to traditional banks. So how do they maintain this special status? Critics argue it's all about the revolving door playbook. The source claims that over 100 individuals have moved back and forth between BlackRock and the U.S. government, including heavy hitters at the Treasury, the Fed, and the SEC. And it's totally global, too. Former BlackRock executive Friedrich Merz is a major political figure in Germany, and the firm actively advises public entities like the Canada Infrastructure Bank. According to critics, this kind of access allows BlackRock to shape public laws and regulations from the ground up, totally in their favor.
But hey, absolute power rarely goes unchallenged. Enter Part 4, the ESG distraction. In the late 2010s, massive public backlash over climate issues and corporate control forced BlackRock to drastically pivot its public relations strategy.
The source maps this out as a highly calculated maneuver. Basically, BlackRock rebranded itself as a moral champion of ESG, environmental, social, and governance investing. Internally, this allowed them to paint their ETFs green and charge premium management fees. But the backlash? It was absolutely fierce. Major investors like Sam Zell and Chamath Palihapitiya called it a complete fraud. States like Florida and Texas actually pulled billions in protest, accusing BlackRock of pushing political ideology over financial returns. Once the political heat rose and profits started waning, BlackRock quietly abandoned the hype train. By 2024, their support for ESG proposals had plunged to just 4%.
Which brings us to the climax of this explainer, Part 5, the $68 trillion infrastructure play. With the ESG narrative largely abandoned and the ETF market reaching a saturation point, Larry Fink needed a brand new frontier. So, in early 2024, BlackRock made a massive $12.5 billion acquisition of global infrastructure partners.
To put that into perspective, the pure scale of what they are targeting is absolutely staggering. By 2040, the world is going to have $68 trillion in structural demands for infrastructure. Fink is moving away from abstract financial products you see and moving toward owning the physical, unmovable lifelines of society. We're talking airports, power grids, and shipping ports.
And the source points out a deeply controversial aspect of this whole strategy: post-war reconstruction. The source claims BlackRock was incredibly fast to secure rebuilding deals in Ukraine with President Zelensky and is already poised for the inevitable rebuilding in places like Gaza. Critics highlighted in the source point out a glaring cycle here. BlackRock holds massive index stakes in defense companies like Lockheed and Raytheon, companies that profit heavily during conflicts. Then, they utilize what they call catalytic capital to secure the rebuilding contracts. In this setup, public taxpayer money guarantees against the risk, while the private firm takes the profit.
Let's look at a specific anecdote from the source that makes this very, very real. They highlighted a $23 billion deal to place the Balboa and Cristobal ports of the Panama Canal under private American control, an effort spearheaded by Fink. This perfectly illustrates how they are securing regional monopolies over critical global trade choke points. Think about it. If they own the canal, or your city's only water system, you simply have no alternative but to pay whatever it costs. The source heavily contrasts public versus private infrastructure to hammer this home. Public infrastructure ideally prioritizes universal access and continuous maintenance for everyone. Private infrastructure, however, is often driven by 30-year service contracts totally focused on profit extraction. The source actually cites the UK's water privatization as a catastrophic warning, where maintenance was allegedly deferred in favor of extracting profits, leading to massively higher prices and heavy pollution. Ultimately, the core thesis of the source material boils down to this: BlackRock has completely transformed into an everything store for the global economy. They own stakes in green energy, fossil fuels, defense contractors, and the very infrastructure needed to rebuild after those weapons are used. They are designed to profit endlessly, regardless of whether the world moves toward peace or sinks into conflict. They truly only respond to the absolute flow of money.
Which leaves us with this final, incredibly important question to ponder. What actually happens to our society when a single private corporation is allowed to own the inescapable physical lifelines of modern civilization? I highly encourage you to look a little deeper into the physical infrastructure around you, and as always, keep learning. Thanks for joining me on The Explainer today.